Hi, I'm Ruban Selvanayagam from Property Solvers. Over the last couple of decades, one of the most popular strategies in UK property investing has been the buy, refurbishment, refinance rent model, often shortened to BRRR. The concept is relatively straightforward. You typically buy an undervalued property, carry out refurbishment works, refinance onto a longer-term mortgage at a higher valuation, pull out a large chunk of your original capital, and in some cases even more than you initially put in, before repeating the process again. In the right market conditions, it worked extremely well for many investors, but in 2026, the model is changing quite significantly, and not just because of higher interest rates. The entire operating environment around property investing has become more complex, more regulated, and less forgiving than it was during the cheap debt era. So in this video, I want to break down what's changed, where the risks now sit, and why the BRRR strategy increasingly needs to be approached more like a long-term business model, rather than simply a growth strategy. Let's jump in. A few years after the 2008 financial crisis, the buy, refurb, refinance rent model benefited from relatively low interest rates, easier refinancing conditions, and generally rising property values. That meant that assuming properties were bought at the right price, investors could recycle relatively modest amount of capital and scale portfolios fairly rapidly. But in the last few years, a lot of those assumptions have changed. One of the main reasons is that higher interest rates have materially altered the economics of refinancing. Even where property value has increased following refurbishment, the refinance proceeds may not be as strong because lenders are applying stricter affordability and rental stress testing. In simple terms, lenders now want a bigger margin between the rental income and the mortgage payments. That means some investors are finding that they can no longer extract as much capital as they expected, even if the refurbishment itself has added value. And this is where the margin for error becomes important, because during periods of low interest rates, weaker deals could often still work because financing costs were relatively low and values were generally moving upwards. Now, higher borrowing costs and tighter underwriting standards expose weaker assumptions much more quickly. Refurb costs have also had a major impact. Labour, materials, contractor availability, and compliance costs have all increased significantly compared to where they were 5 or 6 years ago. That means allocated budgets can become less predictable, and contingency planning becomes far more important. At the same time, slower market conditions can create additional valuation risk. If comparable evidence weakens or buyer demand softens, refinance valuations may come in below expectations, which directly impacts leverage and cash extraction. And if the refinance doesn't clear bridging finance or large cash commitments comfortably, the pressure on the investor increases very quickly. But also, one of the biggest changes affecting the BRRR model isn't just financial, it's operational and regulatory. Historically, many investors focused heavily on the acquisition and refinance stages of the strategy, with the assumption that the hold phase would largely take care of itself. But in 2026, being a landlord has become materially more complex and more businesslike than it was a decade ago. The introduction of the Renters' Rights Act, ongoing EPC upgrade requirements, licensing schemes, compliance obligations, and rising management standards have all increased operational pressure across the sector. For some landlords, particularly those with older or lower quality stock, the capital expenditure required to remain compliant can materially affect long-term profitability. Upgrading older housing stock to meet future energy efficiency standards, for instance, may require substantial investment in insulation, heating systems, windows, or wider refurbishment works. And some properties are simply much harder and more expensive to upgrade than others. This means investors now need to think beyond simply buying cheaply and refinancing quickly. They also need to think carefully about the long-term operational viability of the asset itself. And all this continues to lead to a gradual professionalisation of the rental sector. The combination of taxation changes, compliance burdens, buy-to-let refinancing pressure, and regulatory reforms has pushed some of the smaller landlords to reduce exposure or exit the market altogether. Indeed, historically, as I mentioned earlier, many buy-to-let investors focused heavily on extracting as much capital as possible, as quickly as possible, which doesn't really work sustainably these days. And that brings us to the core point of operating in the sector today. The refinance stage is arguably the most important and potentially most fragile part of the entire BRRR process. If refinance conditions tighten, valuations disappoint, lender appetite weakens, or if interest rates remain elevated for longer, the underlying viability of the strategy can change very quickly. And that's why thinking about the long-term exit plan and liquidity matter more than ever. Because ultimately, a property investment is not just about whether you can buy and refurbish it. It's about whether the asset remains financeable, lettable, compliant, and sellable over the long term. But at the same time, it's important not to be overly bearish about the sector itself. One of the realities of the current market is that all these operational issues are likely to reduce the number of speculative landlords and new entrants over time. And when supply becomes more constrained while tenant demand remains relatively resilient, there's a good chance that rents continue moving upwards in many parts of the UK. So while the market may now be more challenging for highly leveraged or poorly structured deals, disciplined investors taking a more strategic view are still likely to perform very well. In many ways, I believe the increased professionalisation of the sector is actually a positive thing. The landlords most likely to succeed going forward are those that are focused on low gearing, better quality assets, sensible contingency planning, and properly stress-tested deals. The buy, refurb, refinance rent model hasn't disappeared, But it has changed and will often require investors to leave in more capital. But particularly during periods of market volatility, this arguably isn't necessarily a bad thing, and of course will probably result in healthier cash flows across the portfolio. Cheap debt helped many investors scale quickly during the previous cycle, but today's environment requires more careful analysis, tighter risk management, and greater focus on long-term sustainability. A big thanks for watching. If you found this useful, please like and subscribe for more clear, data-led property investor insights. I hope to see you in the next one.